I'm going to affectionately call him the OG, since my understanding is he's joined you and many of the conferences. So he was teaching me as we were preparing. So thank you all for taking the time to continue to join us this morning. And Marty, thanks for inviting me to join this discussion. As you said, I'm joined by the OG Chip Perkins, John Service, Managing Director at Layton Group, and Chip, of course, is the CEO of his own shop, Perkins Fund Marketing, and Gib Dunham, who is currently the Chief Investment Officer at Bridgeway Wealth Partners. So time is tight, and I'm certain you can find significant information about these gentlemen's incredible backgrounds on LinkedIn and more. So I'm gonna let them talk a little bit about themselves, but in general, we're just gonna dive right in. Why am I moderating? And to answer your question, partly because Marty asked, but manager selection is where I essentially started my career. I spent about a decade plus at Bessemer Trust. And the skills and rules and due diligence and asset class understanding have served me well as I've shifted into roles. I currently manage my own practice that's focused on impact investing, angel investing, as well as financial literacy and some other things. So this to me is going back to my roots. I love this stuff. As I like to, when I'm telling my story, I geeked out behind a computer screen for many years doing the manager selection. But as the opportunities increase in the world, it's getting a bit more complicated. There's more EQ and IQ to this story. So I'm excited for this conversation. So let's get started. My first question is a bit open-ended, and so in that I'll ask the panelists to just give a word or two about their backgrounds. But my first question is, in your work, how do you define manager selection? What are the markets do you focus on? And what are your due diligence imperatives? From my manager selection days and continue through now, I focused on people, process, philosophy, profits from an ownership structure, and investment diversification, or investor diversification and performance. My goal was wealth preservation first, alpha generation second. So it's a little bit different. But I'm going to stop there. And as the gentlemen on my panel know, I do like to talk. So we will make this as interactive and interesting and have some good takeaways. So I am going to throw it over to Chip to start with that first question.
Well, background first. We've been 25 years in business as a placement agent, primarily working with hedge funds. We are a broker-dealer. We have everybody in the firm is registered or has multiple registrations, and we've raised about $8 billion for people over the last little while in multiple strategies. We don't concentrate on anything. We concentrate on people that have repeatable process, pedigree, performance, and are alpha generators. To answer your question, what do we look for in a manager? It's first, good answers to all those questions. And secondly, to have something that's a little bit unique and something that is different than everybody out there. But for those investors that are here, I think the performance still remains high on your list, depending on nothing except performance. And if you think that a credit manager should be giving you X and the ones that people are bringing to you are not, move on.
Chip, what are some of those unique factors or defining factors that you look for? Now, obviously, it's going to evolve as the markets evolve, but tell us a little bit more about how you go about identifying those unique factors in your process.
Luckily, I've got a great team that helps me, that delves deep into the performance, the analytics, Sharpe ratios, every kind of ratio there is, using both software and their experience. And then we create matrices that show us how they compare to other managers in their field, whether it's a long short equity guy, and then you look at whether it's a global or a emerging markets or a US strategy. And we do comparisons. But what's key to us when we look at managers and opportunities is, are we hearing from investors that this is something that they're interested in? I went down the road once about 18 years ago, and I thought I knew a lot of stuff, and I didn't, and decided that I should take this convertible ARB guy on, and did not have a discussion with my team and did not have a discussion with managers, and blew up in my face. My team didn't like them. The customers didn't like them. I liked them. And I've learned that I need to have input from all corners when we make a decision on a manager.
And understand the demand, right?
Sorry?
And understand the demand from clients, broadly speaking.
Oh, yeah, because otherwise it's just a complete waste of time. I can bring you this guy and you say, I hate that. I don't want that.
So have you, aside from, or adding to your due diligence, you have to have buy-in, are there any other flags to your process that you've added from that experience, or flags over time?
Well, there's certainly background checks that are extremely important. Most people come up clean as a whistle, but we did have one that showed up a little issue with the FBI, and that suddenly cut him right off from our further due diligence. There's all types out there, so you have to do deep due diligence. You can't just do background checks, but you have to talk to people that have had experience with that manager before or have worked with them in the past. We also ask for existing investors that we can talk to.
I think disclosure is a big part of that too, right? In my manager selection days, we also did deep background searches and financial record searches and all that sort of scrubbing. And we had one manager that had 12 little incidences, like a lien against a second home and an outstanding warrant for a parking ticket. And there's just a bunch of like little teeny smoky fires, but it turned out to be a bigger deal. And then I remember another situation where there was something in the person's background. They knew it was going to come up and they disclosed it up front with some reason, and that made all the difference. And I'm wonder if that's become a little bit more commonplace as information is a lot more available in today's world. So you can find anything about anybody. So
disclosure is very important and being honest and outright, but it depends on what they're disclosing.
Sure.
If they're disclosing a bad divorce, that's one thing. If they're disclosing, I killed a guy in 1968, that's another thing.
Might put that show on MSNBC though.
Yeah, it'd be a good show. So it all depends on what's coming up, whether it's
Right,
your own or others.
Sure, and trusting the judgment, right? Which one should we take into consideration? Well, thank you so much for that dialogue, Chip. John, I'm going to turn it over to you to answer the question. Start with a little bit of your background, but in addition, how do you define manager selection? What do you focus on, and what are your due diligence imperatives?
Yeah, so currently I'm with Layton Road Group. We are so we have two businesses, one being outsourced cap intro, and we provide that to a number of broker dealers, a large asset manager, and as well we're in the crypto market, and we provide that service to FalconX and their managers that are utilizing their platform. On the other side of our business is placement business, very similar to Chip's business, except ours isn't quite as old. We've only been around since 2018, so we're a little newer to the game. We cover, I would say, virtually all strategies, and that's a component of everybody on the team having experience either allocating or marketing alternative strategies throughout their careers. So what I would say with regards to manager selection, I'll just echo what Chip said. He I think covered off on almost all the bases. One of the things I would add to it is Chip mentioned it, but differentiating factors. So if a manager, if you're going to select a manager, they need to prove why they can be in that investor's portfolio, right? So you're either replacing somebody or maybe some new capital came up, but there's got to be a reason, and that goes to how does that manager beat out the other managers from his peer group or her peer group, and I think that's key. And so many managers that you'll run into aren't able to articulate that. They can't come to you and describe why they are the one that you should choose to go down the road with, do your due diligence, and then ultimately allocate in your portfolio. So to me, that's one of the ultimate keys. I think the others obviously all have to be there. Chip mentioned them, goes without saying, but that particular one, I think most managers miss. And if they can accurately and make it understandable, where it's the 5-year-old explanation, right? Like if you can explain it to a 5-year-old, then you've won. And also from the allocator side, the allocators, most of them aren't the decision maker or the ultimate decision maker, so they need to be armed as to when they go to their senior management, and you need to be able to provide them with that. So I think that those are some of the keys when I look at it, and also I just won't rehash what Chip said because he did a great job on it.
John, you mentioned, or maybe in our pre-discussion, that you do work in some crypto.
Yeah, so over the last 2 years, it's an opportunity set that we decided to engage with. Part of that engagement, as I had mentioned, was Falcon X. We also provide placement for a number of different managers. We just see it as sort of the next great bastion, the next wave. It's embedded out there. It's not going away. And it provides an investment set that at times is highly uncorrelated. The different strategies that you're able to engage in today are much better than they were just 2 years ago. And that's due to the expansion of that overall investment, what I would just call ecosystem. And you've got options out there. You have futures markets out there. So there's an ability to properly hedge your long exposure, if it would be, your short exposure. There's arbitrage strategies, and it's in a nascent stage. So you have tremendous volatility, and you're able to take advantage of all this whole ecosystem and variety of different investment sets. And it's one of the reasons why we liked it. And like I said, there's a lot of capital out there flowing into the space. Ultimately, returns will come down a bit, but right now it's really interesting.
So you mentioned that with your more traditional managers, you want them to explain as if they were a 5-year-old explanation.
Yeah.
How do managers do that with crypto?
Yeah, so a little bit tougher, but if you break it, if ultimately you break it down to a fundamental basis, and you can use traditional finance terms, and along with that, because the trading strategies that are out there currently really are incorporating traditional finance, right? Now the underworkings of what you're investing in are different, but it really is traditional finance. Those strategies are market neutral. You have your VC, PE, but it all still falls under those TradFi, the whole system. So I think you can explain it, and you can explain it simply. Getting into the underpinnings, yes, that's a little more complicated, and certainly not everybody is going to know everything about that.
Sure. Thank you, John. Okay, last but certainly not least.
I just want to add one thing that what John said, which I think is really important.
Please.
Which is the differentiation. Because if you have a manager, and I've had a couple of these that will say, I did just as well as X, Y, and Z. And the issue really is they've done just as well. And if you guys have already invested in X, Y, and Z, if they don't do something spectacularly different, you're not going to go through the process and do the diligence and take the time to do that. So this is, again, where performance, alpha generation, exposure, all these things come into play when making a decision on a new manager. But you've got to just be damn better than what they already have in their portfolio. And it's not like everybody doesn't already have long short equity. It's not a new strategy, 10,000 guys out there banging around. And, takes a while
So
to
then,
find.
Robyn, can I just jump in here 1 second? It's Marty.
Yes.
I don't want to lose this train of thought. I don't want to lose this train of thought that John has brought up and Chip as also, which is that how frequently is it a decision to replace a manager versus you're in green fields where there's something brand new, like crypto, for example, right? So maybe you guys can discuss that at some point during this discussion, because I think it's
Yes.
really important.
and I was going to add to that, because both John and Chip have used the word, you gotta do better than the previous manager. And what is that definition of better, right? Understanding my perspective is coming from an impact-oriented investment focus. But that being said, it's got to be about, is it about diversification and performance and draw from the interest from the client. So why don't we pause on that, because I want to give Jib the opportunity to introduce himself, and then we'll come back around to that question. But Jib, tell us who you are and your definition of manager selection and sort of what your particulars are.
Great, thank you. Well, first I want to say thank you to Marty for the invitation to participate today. And thank you to Robyn for moderating the panel. So my name is Jib Dunham. I'm the Chief Investment Officer at a wealth management firm called Bridgeway Wealth Partners. We're about 5 years old, manage over $500 million on behalf of some families, some institutional clients, some high net worth clients. So in my role, in terms of looking for managers and manager selection, I think part of it is it's partly inbound, and we get at least 2 to 4 presentations a day from funds looking for capital, and part of it is, and that's great because we get to see new things, and part of it is saying like, okay, what's our mandate, and going out proactively and reaching out to managers in that category and trying to canvas. I like to look at, if I'm looking at a certain sector, I like to look at least 10 to 20 managers to really get a feel for how they different, the teams, the size, et cetera. I will say I tend to gravitate more towards sort of niche strategies. Earlier in my career, I worked for a $5 billion hedge fund. And I can tell you it's, the larger you get above, a couple $1 billion, it's harder and harder to add alpha. Because if there were $5 billion of pennies on the ground, I'd be picking them up, trust me. So, it's interesting. I mean, I tend to, thought the prior panel was excellent. I like emerging managers. I tend to focus on sort of the key question is, what do I want this? It's not really what does this guy do? It's how does this fit in my portfolio? And, I do think, I tend to find, like, if you just want equity exposure, I can go out and get an S&P ETF. Like, that's not a problem. So where these managers, I think where the world's going is those types of sort of long only strategies are getting more commoditized. I can get that equity exposure elsewhere. For my hedge fund portfolio, what I'm looking for is really sort of an absolute return strategies. I mean, occasionally I might say I want a hedge fund that's got, levered beta, and I can get that there. But really where I think some of these niche managers are, it's I'm looking for unique sources of returns. And so the first question is, how do you generate your returns? And, I invested in a prior firm in a fund that buys life insurance policies. We've looked at rare wines. We've looked at a lot of things. But I like, I tend to like these more market neutral strategies where I can understand, okay, they're getting their returns, not so much from the market, but they're really getting it from stock selection, and then try to dig down and understand, okay, what worked, what didn't work, how are you doing your research? What's your edge in getting these ideas? So that's sort of a high level overview of my approach and my philosophy.
Thank you. Thank you. Okay, so let's turn for a second to the question about sort of timing. and definition of better in terms of replacing managers. What are your tipping points for replacing managers, for adding managers? Is it strategic? Like there's a better opportunity. The other thing to consider and talk about, do estate planning issues get in the way, tax considerations? Because I know that always tends to, we put together these ideas and then when it comes to execution, sometimes that becomes challenging. So Jib, why don't I start with you in kind of talking through some of those thoughts?
Yeah. I think, just in terms of it's really part of it is who your investors are, what the type of capital you have. Because if, in my current job, we're representing families, so taxes are a consideration. So, if something comes up, if something, there's a couple of deal breakers, as Chip said earlier. If I find out someone just didn't disclose something and they have a warrant for their arrest, I'm going to fire that manager. If someone has a down quarter or down month, I don't necessarily fire them right away, but I want to understand, did you operate within the parameters that you spelled out to me in the beginning? Because I can, I'm allocating part of my portfolio to XYZ strategy, and it has a place in my portfolio. And if it doesn't act the way it should act, if someone says I'm market neutral and then, they're down, the market's down 20 and they're down 20, well, they're clearly not within their mandate, or they just had a really, really, really bad month. So, one of my best mistakes, I think, was I invested in a volatility manager that was selling volatility, and then the market dropped, and they had a fantastic record, and then all of a sudden they had a really bad month, down 20%. And they actually did what they were saying to do. That was my mistake because I didn't really, put two and two together. So, but as long as the manager's doing what they say they do, I'll give them some wiggle room.
Got it. John, any thoughts on these questions?
Yeah, I think Gib did a very good job on that. I think too, on the point of getting into the portfolio. So if when you're managing that portfolio, and I'm sure Gib does the same thing, is you always have a manager who's at the margin, and that'll generally be the one who is not adding as much return to the portfolio, and that's generally what's going to pique everyone's interest. And this is outside of the fact that maybe they had a strategy shift or something like that. If they do that, they're out. No questions. That's it. You're gone. But if they tending to drift a little bit and they're just not providing what you anticipated that they were going to provide to that portfolio, they're on the edge. They're on the bubble. And you're going to look for someone to supplant that, right? Because especially if you still want that same risk profile,
Sure.
Relative to return, and you're going to look for someone who is, and really you only get this from a historical basis, but who has done better than these guys especially on a risk reward basis, and what they're going to bring to the portfolio. And so that's, I've always viewed it that way. And to your other question, it's a rarity that somebody comes in and just says, okay, I've got a blank portfolio of $1 billion and I need to allocate that out today, or not today, but over the
That would be
next
fun,
6
right?
months. Yeah. So that's not the norm. And so I think managers just need to be aware that that's the challenge to actually get that allocation.
Sure. Chip, love to hear your thoughts on this question about when to hire, when to fire, opportunistic, strategic.
Jim's got a quick trigger out there. 1 month.
Wow.
I have never had a manager that hasn't had a bad month. I don't know how lucky you guys are, but everybody has a bad month. They can even have a bad quarter. But if they have a 10-year track record, a 5-year track record that's solid, you got to look at that as well.
Sure.
They could be having a bad month. Wife could say you're out of here, whatever. But in our business, we have a limited number of managers that we work with, usually 5, sometimes 6, and we try and provide different opportunities for different kinds of investors, because we have family offices, and we don't do any retail. We have family offices. We've got pensions. We have endowments and foundations. We have publics. that we work with. And when you look at managers, family offices are probably the quickest to invest, and we're in the business of placing money. So we spend a lot of time there. So we always try and have something that is more tax efficient and gives an opportunity for either steady returns and low taxes, because in our business, for the most part, if somebody's giving you 10 or 12%, you're really getting 5 or 6. But if you have somebody who's got a little more tax efficiency in their portfolio, the families like it more, and it makes more sense. So we always look at real assets as an opportunity to do that. But when you're working with a pension fund, you're working with endowments and foundations, they don't care about tax. They want return, they want alpha, they want steady, and they'll go through a couple of down months if they get some really strong long-term performance. So when do I fire people? Well, usually I have a contract, so it's kind of hard to. But if they are just, as I think John said, they're off the reservation, they're not doing what they said they do. If they said, we invest in gold, and they're spending all their time in technology stocks, I can't in good conscience continue working with them. So I have clauses that let me out of the way with stuff like that.
Gotcha. Thank you for that. So the next question, which is becoming, I think, a bigger issue as there's just more cash in general, is capacity. So how do you all take capacity into consideration in your due diligence process, and talk a little bit about how that impacts your clients, right? You put somebody on your platform and you want them to have X number of dollars, and I think we were talking about that $100 million mark to look at a manager. But talk a little bit about capacity as it relates to your due diligence process. John, why don't we start with you?
Sure. I think capacity is a key item. We actually gravitate towards managers that have lower capacity. And so I would say, generally speaking, outside of the crypto ecosystem, but generally speaking, somewhere in the $400 to $1 billion range. But they're gonna cap out. And we tend to do that, one, because we like the nichier strategies. The investors that we tend to work with tend to like the nichier strategies as well. And as Chip had mentioned, we cover the landscape. So that's the majority, I would say. So, well, I would say the largest portion would be family office world. But on top of that, foundations, endowments, pensions, RIAs, and the like. So, and each one of those, I should say, each of those groups has different needs, different desires, and have different return expectations, but by and large. And I'm generalizing here a little bit, but by and large, right? So you're going to need, generally speaking, higher return and opportunity set for the family office world. Chip mentioned they do move a bit faster, and they are willing to generally take slight bit more risk. When you're coming to the foundations and endowments, that drops down. Also, generally speaking, the return expectations drop down slightly as well, so that their attempt is to reduce their downside risk, and they're willing to give up some of the upside for that. And we're always listening to that investor base, taking notes, trying to figure out where they're headed, what they're interested in, what their outlook is for the year, where they are thinking about allocating to. And so in our selection process, we're incorporating all of that. Obviously, we're in the business to try and get people to allocate to these managers. And so if we can find opportunity sets that do have some duration to, meaning that the opportunity set has some length to it in years, then and those groups are interested in those opportunity sets and looking to allocate to them, will more likely than not take the manager on, especially if they've differentiated themselves.
Fantastic.
Again, one more quick question, Rob. I'm sorry to butt in again, but John just keeps on giving me these golden nuggets of thought, right? So again, so he was talking about surveying the investor climate and would love to understand, what his outcomes are from that survey that he's been doing. Like, what are people looking at, right? Are anybody abandoning anything? And then also, if you guys can discuss like the traditional model of investing, I think that the hedge fund guys who were in the prior panel were talking about the 60-40 split between, equities and fixed income or credit. And I mean, from my worldview, a lot of family offices abandoned that in 2008. I mean, your interest rates declined, you weren't getting a lot from credit, and people started looking at private credit, for example. All kinds of other, that venture has thrived in this market. So a lot of people went to alts, right? But if you guys can discuss that and the impact on the family offices and institutional investors that you work with and their outlook, that would be really great. Because I think it's people are really looking at a different model these days, although they still teach 60-40 at Ivy League universities, right? So
I'd like to talk capacity first.
okay.
And then, that was the first question.
Yes.
And then I'll
Go ahead.
Marty. From a capacity standpoint, everybody in my team works on commission. So we need a certain amount, if you're gonna be one of the 5 people we take on, we need a certain amount of capacity that we can fill for you. But I never wanna fill everybody's capacity because, we charge a percentage of what they make. So if they can fill some of the capacity, they don't hate me as much when they're writing the check to me every year because the percentage is lower. So that works out for everybody. But the other thing is when we take on a manager, we know who are the top 100 guys we're going to go after and how much capacity do those top 100 guys really need or want in this particular strategy. So we try and balance it. It's not always easy. Sometimes we go beyond, the capacity, bring it to the manager, do you want it? And if it's a really good customer, sometimes I don't get paid on that because, we have a long-term relationship, hopefully, with the manager. But capacity is very important. If you have, a bunch of great crypto guys and they all can take on 100, well, then you just have to go to 100 guys and have them all give you 100. But it's hard. And to Marty's point, we're not a registered investment advisor, and our job is not to help a family or a university or anybody say, oh, you really shouldn't do 60-40. That's old school. Don't do that anymore. Our job is to find interesting, high-quality managers and present them as an opportunity. And it's up to the institution or the individuals to say, that's something that I am interested in. It's diversified, it's different, it's non-correlated, it's got a low net exposure, whatever it is they're looking for, we're trying to provide amongst those 5 managers. So we don't have anything that's competitive, we don't have anything that's similar. If I'm talking to Marty and saying, hey, what is it you're looking for? He says, I'm looking for low correlation in an equity guy who doesn't do a lot of TMT. Well, if I have that, that's an opening where I can, go after him. But for the most part, don't look to me for investment ideas beyond managers. We do a very good job selecting managers and finding opportunities. But if you took any of my personal stock picks or the way I allocate my money, you'd be in the wrong place.
So to that end, just before we turn over, where do you source your manager ideas from? And maybe if John and Jib have anything to add about sourcing, and then we'll go back to Marty's question.
We look through publications. We work with prime brokers. We work with accountants. We work with some lawyers, and word of mouth. We've been doing it a really long time, as you can see from my hairline. We're always on the lookout. So I get a lot of recommendations from other managers that we've worked with in the past as well. So that's it's good. Probably my best people end up coming through word of mouth.
That's awesome. That's really neat. Jib, John, anything to add, capacity or sourcing? I think both of you answered capacity.
Yeah, I would say this on the capacity side, I usually don't run up against that issue. I tend to get in smaller managers. I think that's where the alpha is.
Sure.
I'm not afraid. There's a sort of an institutional issue in that most of my competitors, the large banks, won't. They need to put $1 billion to work, and they don't want to be more than 10% of a fund. So by definition, the fund has to be 10 billion or larger. And I just think it's very hard to move that ship. So, I'm not afraid. I've done manager seeds. I'm probably one of the few people in the world that is not afraid to be an outsized position of a fund. That doesn't concern me so much. So I think that there are opportunities within that to find those sort of early managers, managers on an early stage that sort of before they get too big.
Sure.
Yeah, and no, sorry, Robyn,
Please.
I was just going to say that from a capacity perspective, I think that there's not enough of the gives out there. we definitely need more of that. Early stage, early entry. I think a lot of groups say they do that, and when it push comes to shove, they don't. So I think that it's good to have people who do focus on that. The alpha is definitely in that range. I do believe, and if you get too big, I think it's definitely a challenge to maintain those returns. So that's the only thing I would add on that.
John and Jib, add to the question about sourcing. Where do you find?
Oh yeah, sorry. So I would mention the same thing. Virtually all the managers that we represent have come through some kind of connection or trusted network that we have, and or other managers. Those that haven't come through those through our networks, those have not worked out optimally, is what I would say. So it almost never happens that we take someone on that didn't come through our network.
Was that impacted with COVID and the lack of sort of natural interaction?
No, actually it wasn't, because Zoom came online. So actually I take that back. For the for the first 3 months, it definitely had an impact. After that, it did not.
Sure.
Zoom came online, everything. I think I had more connection.
That is certainly a silver lining. But it also leads to a lot more work, especially when I'm, for me, for doing my angel work, now that you can get online with anybody from anywhere, anytime. It's quite remarkable how the pipeline has grown and doubled and tripled. So thank you for that. Jib, do you have anything to add on sourcing?
Yeah, I really don't. Just friends, former colleagues.
Same idea. People connections. Yeah, that is the way it
You'll be
goes.
hearing from me, Gib.
Right.
Same.
So we have one question from the audience, but before I take that, do we want to tackle Marty's question about process? And there were a few other things in there which I did not do my moderation duties and take note, but
Well, we can say we did. He's out of the room.
fantastic.
Right?
Did anything pop into mind as Marty was asking the question for any of you that was particularly salient about your process?
I think he mentioned the 60-40.
Yes.
And I think anyone who's got more than $1 million or even less than that should be considering these types of strategies, either to add income, add alpha, add downside protection, whatever it is.
Understood.
The real question to me is it's less about 60-40 and it's more about the 60-40 applies less to stocks and bonds and more about liquid versus illiquid and how those implications, how that plays in your portfolio.
Well, sure, right, because that opens up that's a great point. It opens up the opportunity set depending on how you need to utilize the dollars. So
Yeah,
Okay,
and Robin, I would just add to that,
Sure.
that historical 60-40 model, I think the return opportunity set has altered itself. And so investors, especially endowment and foundation type that have capital that is, they're investing for 30, 40 years or 20-year periods where they can take advantage of duration. And a lot of those portfolios have moved
Yeah.
out on the duration curve. So
Sure.
that, at least that's what we've seen. And certain strategies have just their return expectations have become lower, and so it doesn't avail itself to put capital there.
Or do
And
some of
yeah.
those strategies become anchors in portfolios? Now, I know that's not necessarily your goals, but sometimes, right, for need of capital placement, sometimes what's best for one is not necessarily best for the other. And I think that was a really important lesson that I learned overall from my manager selection days, was that you can do an insane amount of due diligence and put together, a slate of incredible investment opportunities for one family, and they just don't make any sense for the next, which
Right.
is an interesting challenge, but also an opportunity. So thank you for that. So the question that comes from the audience, and this is one on my list too, but themes that will stay long-term post-COVID, themes, trends, what are you seeing in a post-COVID world from a manager selection perspective? And thanks, Rob, for that question. Jib, do you want to start? Any thoughts?
Yeah, I mean, COVID's just another long line and reasons that the market sold off, right? And changes the world. I mean, we had SARS in 2002. We've had other issues. So I think it's just how you position your portfolio over time and how you rebalance according to what the market does. I mean, the market's been very soft. We had a great market in 21, and then the last 2 months have been somewhat terrible. I think you just have to have your slew of managers. If you have a view that the market's going to go up, I've got managers that will participate in that side. And if I think I'm at the top, I got there probably too early, but shifting more towards defensive strategies, so you don't lose as much when the market goes down. I think COVID. I don't think my COVID has really changed my methodology at all.
Wow. Okay, that's fair. That's interesting. John, what about you? Thoughts on trends in the future post-COVID? Has COVID impacted you?
Yeah, so I would say that COVID has altered the due diligence landscape, and has enabled, I think, that what was needed. So not everybody had to do an in-person meeting. They figured ways around it. So that process has evolved. With regards to trends and I don't think that that'll go away. And as well with regards to managers having to all be in one, the team having to be all in one space. That also is going by the way of the dinosaur. That's just isn't going to happen going forward. I don't believe. And we're seeing it in a variety of different ways.
Right.
But from an investment perspective, we're seeing a lot of demand, and this demand I don't feel goes away anytime soon in the healthcare and technology sector, and a combination of the two. And that's just a wave where, and I've always said this, and I didn't coin it, but if you can pick a few of those different waves that are coming through, you have the ability to make more mistakes and make more money. So and those mistakes are less penalizing than if the wave is over and the wave's falling on you. So I think that if you can pick those out, that's one of them. There are others out there that we're seeing, and as Marty had mentioned early on, private credit certainly is out there, continues to go, and that I don't think is going away anytime soon.
So interesting that my recollection from my selection days was I could do all the research, all the due diligence, and have conversations digitally with the manager. But when you got to their office and you saw them sort of at work and the models in person and deep diving, I can say with relative certainty that half the time that changed our minds, sometimes for the better, sometimes not.
Mhm.
So it's interesting that now, in a post-COVID world where site visits aren't sort of the mandatory, how you have to shift your due diligence process, right, to get at some of those things that you might not
Right.
see.
And I would also just add to that you regionally, the diversity of where managers are opening up their shops or have moved to. New York is still the center, but less so.
Right.
And those managers have moved out, and I think that continues as well.
And there's no, other than banks moving to Florida, there's really no trend. Sort of folks are going where their lives are taking them, right?
In
Yeah,
one
well,
weird,
I can tell you there's
Dallas,
a big trend to go to
Houston.
Florida.
Hang on. Well, you're in Florida, so. Jim, did you have something to add?
I would say in an interesting way, actually, I think COVID has forced a lot of firms, including my own, to change their internal processes, and everything now is digital. We don't have, it used to be you had those big green file cabinets,
Yep.
right?
Yep.
None of that, and it's so good because now I don't have to worry about fire or flood or losing. And once you write something down on a notepad, you'll never ever. I've never ever looked at a notepad ever, and I have like stacks of them, right? So going to putting everything digitally is amazing, and plus just opening accounts with DocuSign, it's the best.
Yeah. Yeah,
Well-
no, and that's streamlining, and that makes it easier to do the stuff that we like to do. I hadn't really considered that, but yeah, digitization and being forced into it,
Yeah.
right, is probably pushed the trends and everything forward some. Chip, anything to add?
Yeah, I think one of the things that I'm actually looking forward to is FINRA always wants us to have personal contact and go to the offices. I only work in hedge funds, and I've always found that it's a very personal business. And if you can't look somebody in the eye and shake their hand, it detracts from your relationship. Because it's not like you're using Fidelity and you're gonna put your IRA
Sure.
with
Sure.
some 24-year-old kid. You're gonna put a serious chunk of cash with these people. And not meeting them, even through Zoom or whatever, it's not the same.
Sure. No, I hear that.
And for the first time in 25 years, I have a manager in China that I've met them here in the States. They were here, but I haven't been able to go and look at their offices or how they're set up or anything, just because of COVID. And I'm kind of looking forward to actually seeing what they're made of over there.
Yeah.
But, I think that that's not going to disappear with Zoom and Teams and everything. People are going to have a desire. Right now, it's working okay for some, and people have, like they have
I agree.
changed
I
and
agree.
everything. But
agree.
given the opportunity to go and kick the tires and shake a hand and look them in the eyes is pretty important.